I had a sneak peek at my housing data's latest national rental market report. Let me tell you, the message is clear. Rental markets are tight, vacancy rates remain low across most capitals, and despite some moderation in rent growth, the pressure on tenants hasn't eased. So, in my chat today with Australia's leading housing economist, Dr. Andrew Wilson, I'd like to explore where rents are holding firm, where they're still climbing, and what this means for investors navigating this tricky landscape. And then we're going to turn our attention to something a bit more optimistic: inflation. For the first time in a long while, both headline and underlying inflation are sitting squarely within the Reserve Bank's target range. That's significant because it ticks a key box for potential rate cuts as early as next week even. Of course, we're going to wrap it up with the auction market report, and August started off with a bang. So, Andrew, lots to talk about today.
Yes, Michael, and a bit of the same old, as you suggested with the latest rental data. We saw a tightening almost across the board in rental markets over July. Vacancy rates down, I think, just about every capital city for units and houses bar one. So, but these things sort of fluctuate because they're at such low levels. They can move from, because there's such small numbers of rental properties available or being advertised, it can fluctuate from month to month. But the bottom line is it's very low, these vacancy rates, and getting lower. The only interesting point is we're not seeing a breakout in rents as yet. But the basic law of supply and demand tells us that eventually we will see higher rents. And I think it's just affordability constraints that are holding it back at the moment. And I don't think it'll be too long before these very low vacancy rates translate into higher rents. So let's have a look at the performances in the capital city. It was quite benign rental growth over the month. Sydney, Melbourne, and Perth were all flat over the month. Adelaide down slightly by 0.4%. Also Canberra down 0.4%. Brisbane up 0.8%. The only big move was Darwin down 6.3%, but that followed a strong rise the previous month, and the Darwin rental market can fluctuate quite significantly from month to month because it has only a very small amount of rental properties, and we're talking about houses here, of course. Over the past year, all capital cities have recorded growth in rents over the past year, with the exception of Sydney and Melbourne. Sydney's down 2.4% for houses, down 4.8% in Melbourne. But it's the vacancy rates that really stand out here, Michael. Every capital city, with the exception of Melbourne and Canberra, have vacancy rates below 1%, and that's very low. We know that the balancing point in the market for rentals is typically around about 2% vacancy rate, lower rents above 2%, higher rents below 2%. But Melbourne's now at 1%, and its vacancy rate for houses has fallen sharply over the past year. And Canberra is the outlier, but still at a very low 1.3%. But the majority of the capital cities have vacancy rates in the 0 point something percent. That's very low. And we've seen these numbers before, Michael. It's just, I guess, after, and perhaps it was that easing in migration, student migration through government policy initiatives last year that have that eased vacancy rates, but they've certainly tightened this year, particularly over the past 2 or 3 months. And the only steady market was, in terms of vacancy rate, was Darwin. And of course, we just mentioned before that Darwin house rents fell by 6.3%. So tightening vacancy rates for houses means there's not a lot of choices out there for tenants, and given strong competition for rental properties, we'll likely see higher rents sooner rather than later. Similar story for units, Michael. Not a lot of movement in rents, perhaps a little bit more movement when we compare them to houses. Sydney was steady for unit rents. Brisbane also steady. Canberra down just 0.2%. Melbourne and Adelaide, Melbourne down 0.8%, and Adelaide down 0.9%. Hobart and Darwin rents, again, very small unit rental markets. They surged over the month, up 2.5%, Hobart, and up 5.2% for Darwin, which moved significantly the other way compared to houses in that city. Perth saw a fall in unit rentals over the month, down by 2.6%. All capital cities, with the exception of Darwin, have recorded higher rents over the past year, and the top performer was Hobart. Again, a very small unit market, so we tend to get a volatile numbers from period to period, even on the annual results. But Brisbane, Adelaide, and Perth have been of the major capitals have been the big movers in annual rental growth, along with Canberra, which was the best performer, up by 8.2% over the year. Now, similar to house vacancy rates, Michael, all our capitals actually recorded lower vacancy rates over July compared to June. A little bit higher, the vacancy rates for units. The outliers at the top are Canberra at 1.3% and Melbourne also at 1.3%. Hobart at 1%, but all the other capitals, Michael, have vacancy rates below 1%. So similar scenario, shortage of rental properties, unit rental properties, and tightening. And we are sort of moving through, I guess, the midwinter period now. So we're likely to see more demand coming through, and really no prospect of more supply. As we know, our supply lines remain subdued. Just interesting, Melbourne, Michael, its vacancy rate for units has plunged over the past year, down now to 1.3%. Although that's the highest of all the capitals, it's down around about 1% plus over the past year. In fact, over the past few months, that Melbourne unit vacancy rate has fallen sharply. So, some obvious signs there that that demand is really moving strongly ahead of supply in the Melbourne rental market for both houses and units. So, not much of a prospect there for any relief for tenants, but good news eventually, I guess, for landlords, Michael, because at the very least, without seeing the expected rental increases, it means that there's plenty of options, plenty of choices in terms of prospective tenants for landlords. So they have a big pool to choose from, given these low vacancy rates.
Well, as you said, it's winter time or the end of it now, and over winter there isn't as much movement between properties. There was also holidays and things like that.
Yep.
So with springtime, people start thinking about where am I going to be, where am I going to be, summertime, school zones for next year. So yes, there's going to be a movement there. Now, the big news over the last couple of weeks, Andrew, has been inflation, because we know that the Reserve Bank has been waiting for the quarterly inflation figures to confirm what the monthly figures have done. They're meeting next week, and there's a lot of anticipation about what they're going to do this time round. What's going on, Andrew?
Well, if those that are looking for lower inflation to validate an interest rate cut, they'd be pretty happy with the results. As you mentioned, Michael, the Reserve Bank has said, a bit of a surprise to many last month when they held firm on their decision. They decided to leave official rates where they were. Many were expecting them to fall, but the Reserve Bank was quite clear that it said it was waiting for the June quarter inflation numbers. Of course, the Reserve Bank does focus on the quarterly data results, particularly the underlying measure of inflation. So I said it was just waiting for that June quarter result to confirm that inflation was, looking like it was finally under control. And the data, validated that position. Headline inflation down to just 2.1%, Michael, compared to 2.4% over the March quarter. And underlying inflation was also down, and that's the measure the Reserve Bank prefers, because it takes out the volatile elements of the basket of goods that the ABS measures in terms of the inflation rate. Down to 2.7%. Goods inflation was down to just 1.1%. Of course, we have seen a sharp fall in goods inflation due to lower fuel and electricity costs. But services inflation has been a little bit sticky, holding up. But that's also was down, which is probably good news, because both services and goods inflation have been are now moving downwards. And even though services inflation isn't in the target range per se, it's obviously assisting the overall inflation rate to be quite low and within the target range. Of course, the target range, and just mentioning that services inflation number at 3.3% is the lowest in 3 years, Michael. So some good news there, because services inflation can be sticky in a strong economy, because higher wages, obviously with high demand for labour, means that businesses tend to push their prices up above the normal notion of goods inflation, which tends to have a sort of a retail and wholesale element to it. So lowest in 3 years for services inflation. And of course, what we're seeing with these headline numbers is a consistency within the target range. And of course, the RBA's target range for inflation, underlying inflation, is 2 to 3%. We're now fallen from just under that target range to now looking to be in the middle of it at 2.7%. So really, I guess it ticks the boxes, or ticks as the big box in terms of inflation for the preconditions for a rate cut. Michaels, I'd suggest that it would be, of course, we don't know what's going to happen between now and then, but it would be a real shock if the Reserve Bank didn't cut rates on the basis of the latest data. And certainly, there's been a consistency in the fall of underlying inflation since it peaked back in 2022 at 6.8%. As I mentioned, now that acceptable 2.7%, and certainly the trends are positive for that to continue. Now we also have, and what's interesting, Michael, is if we talk about inflation, we're going to see the end of the quarterly inflation series from the ABS. They're going to go with the monthly inflation data from now on. Well, not from now on, but from November. So November will produce the October monthly data set. So that will be the beginning of a continuation, which it has been anyway, of monthly data for inflation, but no more quarterly data measures. And when
They
that
won't have an excuse anymore.
no, that's right. But look, it's good because we've really lagged behind the rest of the world, or advanced economies, in terms of looking at quarterly data for inflation rather than monthly data for inflation, which most advanced economies use. So we've sort of caught up with that, and that's good. And we also had the monthly inflation released last week, Michael, and we do obviously promote or discuss the monthly inflation data as it comes out, because it does give us more of a real-time indication of what's happening with inflation. So even though the quarterly data was obviously acceptable in terms of matching the target range, the monthly data for June gives us a sense of what's happened in a more current environment. And that also was some very good results in terms of controlling inflation. June was down to 1.9% compared to May, 2.1%. And underlying inflation over June was down to 2.1%, Michael, compared to 2.4%. So these numbers are actually lower than the quarterly data set. So it means that there's plenty of momentum going forward into the next period in terms of particularly the quarterly data set, the last one that will come through, in terms of maintaining where we are with inflation. So that's more, I guess, positive news for the Reserve Bank that's wanting to control inflation going forward consistently. So it knows that the June numbers are still on track to continue to do that. Fuel prices were actually higher compared to the previous month, but they still fell. But it was a fall of 10% over May, and now a fall of 8% over June. So still lower, but not as low. Electricity prices actually improved to a fall of 6.3% from a fall of 5.9%. So fuel and electricity have been the main drivers of lower inflation, and rents also were a little lower over the year. An increase of a rise of 4.2% versus 4.5% over May. More good news in terms of the monthly inflation data, Michael, and that just sort of validates that whole big picture, which is that inflation is now probably satisfactory to the Reserve Bank, its targets, and that is not an impediment anymore to lower interest rates if it feels that lower interest rates are required. And just adding to that, we did have a little bit of a softening data set on the labour market for June with that latest data. So maybe that's even another factor that would encourage the Reserve Bank to think, well, maybe it wouldn't hurt just to give the economy a little bit of a kick along with lower rates. So I think it would be a real shock if we didn't see an interest rate cut, but there's still a week to go before that decision occurs, and anything can happen.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with one of the wealth strategists at Metropole to discuss your goals, your options, and what you could do? We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. Remember, property investment's a process, not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a home, go to metropole.com.au and organise a time for an obligation-free chat. You're going to find that at Metropole we're big enough to tip the scales in your favour, but still small enough to care. And since we don't have any properties to sell, our advice is independent and unbiased. Well, as with everything with the Reserve Bank, nothing's guaranteed, but everything's pointing into the direction of an interest rate cut, which they said was coming at some stage, but they said be cautious. They're not guaranteed to come month after month, and that makes sense. Last month, in the winter months, the auction market held very strong. We're now in August, the last month of winter, and I guess lots of buyers were anticipating an interest rate fall because they were out in force over the weekend.
Well, they've been out in force for months, Michael, and particularly over winter. It's been a very strong winter market, atypically strong winter market, and we're usually a quieter period of the year, of course. We're still in winter, but it is the last month because we see fewer listings. There's a holiday period through July. And of course, a lot of people take holidays irregardless of the school schedules to escape perhaps to the Northern Hemisphere if you've got the money. But it also means that we get a lower proportion of higher priced properties in the marketplace. So it is a hiatus in terms of the housing market activity, but we really haven't seen it this year. We've certainly seen lower listings as we usually see during winter, but that's been offset by a surge in buying activity, Michael, and that's been pushing up interest rates almost to that sort of boom level of 80%. And it continued on to start August with the first week of auction results in August. Most of the capital cities recorded results above 70%. So there's some real consistency there, Michael. And we are starting to see the first signs of the spring selling season, not in terms of buyer activity, but it's seller activity. Listings are rising. They will continue to rise over coming weeks. And that'll test the market. With 70% plus clearance rates almost everywhere. It's really matching every test our very strong housing markets at the moment, Michael. So if we look at the data, Sydney auctions up a little bit, signs of spring. Clearance rate very similar to the week before, 77.5%. That is a strong result, Michael. Clearly a seller's market in Sydney. And higher than where it was at the same time last year at 69.7%. That Melbourne market keeps on keeping on. It's almost a shock if we get below 70% in Melbourne now, Michael, and just under 75% in Melbourne, following the 78% nation-leading result the week before. And we can, as we always do, when we look back a year, we can see just how that Melbourne market has advanced, up 10% compared to where it was a year ago in terms of the clearance rate. The Brisbane market has been, these are good results for Brisbane, anything over 50%, 56.6%, a little lower than the week before, auction numbers down. So the Brisbane market, as we know, has a different auction culture, and typically 50% plus is a positive result for sellers in the Brisbane auction market. Adelaide's back in town after a quiet beginning to the year. Was Australia's strongest auction market a year ago, or the first part of last year. Now back up, pushing towards an 80% clearance rate, which it was par for the course at the beginning of last year, or through the first 6 months of last year in Adelaide. So some strength in that Adelaide market again. And look at Canberra, Michael. We've been talking about the resurgence of the Canberra market. It's sort of trundled around the mid-50s for a couple of years. but has started to pick up over recent months and certainly over recent weeks. And this is the first 70% clearance rate we've seen in Canberra for a couple of years. Canberra market, if that's on the move, it really does show that there's an overall drive in interest from buyers in real estate across the board, even in those markets that have been subdued, such as Melbourne, which is clearly up and about. And now it looks like Canberra is following the trend of the other capital city markets. And we have been talking about interest rates, and of course, lower interest rates will do that to you every time. When we look at the trends, Sydney, all the trends are very similar, and they do follow on from lower interest rates in February and May, and that is higher clearance rates since that period. Sydney tracking higher than a year ago, Melbourne clearly higher than a year ago. Brisbane also on the march since April and May, and now in the mid-50s following those mid-40 results. And as I mentioned, Adelaide too has revived. It's very similar, the trends, the monthly trends in clearance rates, Michael, since those interest rate cuts. And Canberra now remarkably tracking around about 10% higher than where it was a year ago. And some consistency there also, June, July and August. So it has been a very strong winter market, Michael, of course. It really, you couldn't set a better foundation, I guess, particularly if you're a seller, for the spring selling season, which is, we could almost say is upon us. Certainly buyers are very interested in property at the moment, and sellers are coming back out again, as they usually do at the beginning of August, and that will rise over coming weeks. So it'll be interesting to see if these 70% plus clearance rates continue through, but a very heady environment. And, Michael, the next thing we will see, and this is what we see in the cycle, is people start to realize, quite firmly that this is a rising market, and you then start to get demand being brought forward. And that's that sort of fear of missing out environment that people start to think, gee whiz, I better get into the market now, or I'm going to be paying a lot more down the track. And that's the next thing to look out for. But another good result over to start August in our auction markets. And really, it's been a very positive year for housing market activity, Michael. And as we've already discussed, if there's another interest rate cut, gee whiz, what an entry into the spring selling season with the strong market conditions and another interest rate cut in all likelihood as well.
We know that more buyers are going to be looking over the next couple of months, and also there's going to be more people putting their properties on the market. And when that happens, the media keeps coming out saying more stock, property values won't go up. What they tend to forget, Andrew, is that most people selling their houses are also buyers.
Buyers.
Sellers are buyers in general, and so there'll be more transactions. But
yes.
I think more stock on the market is going to be good, but there's also going to be more competition.
That's right. And we're absorbing at almost boom time rates at the moment, pushing up towards, it's not a boom yet, but we're pushing up towards those 80% clearance rates. So the next few weeks will be interesting, given that we will see higher stock numbers.
Well, we'll catch up again next week, and we'll get some clues that are in the news. Look forward to seeing you then.
Thanks, Michael.